Something unusual just happened in the silver market. Silver crossed $67. For most people, that sounds like just another price move. Another headline, another spike on a chart. But for the financial system, $67 is not just a number. It's a trigger. Modern markets aren't controlled by humans anymore. They're controlled by algorithms, rules, and automatic risk systems. When silver reached $67, those systems didn't panic. They activated. Actually, that moment, the market stopped being about buying and selling and started being about enforcement. Margin limits were recalculated. Derivative exposure was real. Obligations that were once theoretical suddenly became real. The real stress doesn't happen when prices move. It happens after the move, when charts look calm, but balance sheets are under pressure. Right now, the most important activity isn't happening on trading screens. It's happening inside clearinghouses, risk models, and settlement systems. New headlines, no breaking news. Just quiet calculations determining which institutions can survive and which cannot. By the end of this video, you'll understand why $67 is a breaking point in silver markets, why the real crisis unfolds after the price move, and how these hidden mechanisms can impact the banking system your savings, retirement, and daily transactions depend on. History shows us one thing very clearly. The most dangerous financial moments are never loud. They happen quietly before anyone knows. To understand why $67 matters, you have to understand silver's real role in the financial system. Silver isn't just a commodity. It sits at the center of banking, balance sheets, derivative contracts, and leveraged trades worth billions. Large institutions don't manage exposure casually. They operate using mathematical risk models. And inside these models are predefined stress thresholds. These aren't opinions, they are rules embedded in systems. When silver trades below these levels, losses are manageable. But at $67, losses start exceeding assumptions. Collateral requirements spike. Positions that were once safe become impossible to maintain. Once this line is crossed, the system doesn't wait for human judgment. Automatic enforcement kicks in, margin calls are triggered, positions are reviewed, capital is demanded, price discovery ends, and risk containment begins. $67 is not hype. It's a mathematical breaking point, and what happens next depends entirely on how much pressure the system can absorb before something gives. Most people think financial stress occurs when prices move rapidly, but the real pressure begins after the move. When silver crossed $67, visible activity slowed, but that's deceptive. Markets may appear calm, but clearinghouses and risk engines are working overtime. Every position is every loss becomes real. Margin requirements are updated instantly. Banks cannot hedge easily, liquidity thins. Options vanish. All they can do is prepare collateral, reduce risk, and sell assets. The most dangerous part? This all happens quietly. No panic, no dramatic headlines, just silent stress spreading through balance sheets. Financial crises rarely explode the moment a trigger is hit. They develop silently during recalculations and overnight adjustments. Silver hitting $67 didn't end the event. It started the clock. What unfolds next will determine whether the pressure stabilizes or escalates into a full-blown systemic issue. Almost nobody talks about this, but the settlement window is where crises actually form. A trade isn't final the moment it's executed. There's a process, obligations are finalized, collateral is verified, delivery requirements are enforced. When silver crossed $67, this window became extremely dangerous. Theory ends here. Reality begins. Clearinghouses don't care about headlines or investor sentiment. They care about numbers. If a bank's exposure exceeds limits, enforcement is automatic. More collateral is demanded, positions may be reduced or liquidated. There's no negotiation, no delay, no wait and see. Many banks rely on assumed liquidity, expecting calm markets to roll positions forward. But during settlement stress, everyone needs cash at the same time. Assets can't be sold at fair prices. Borrowing becomes impossible or very expensive. Risk spreads quickly between institutions. A contained move suddenly becomes systemic. Not because prices keep rising, but because obligations can't be met. The settlement window doesn't create panic. It creates pressure. And sustained pressure is what breaks financial systems. Most people assume banks can just step in and solve the problem. That assumption is wrong. Banks fail not because they lack assets, but because they lack liquidity, cash available immediately. When silver crossed $67, multiple institutions faced the same challenge simultaneously. Everyone needed liquidity at the same time, but liquidity only exists when confidence exists. If all institutions try to raise cash at once, the system locks up. Selling assets quickly creates losses. Borrowing is expensive or impossible. Requesting emergency support signals weakness. Even central banks move cautiously. Acting too early triggers panic. Acting too late allows pressure to compound. Banks are forced into damage control, quietly reducing exposure and preparing for worst-case scenarios. This phase is most dangerous, not during a crash, not during headlines, but when everyone is scrambling silently for liquidity. Once confidence breaks, speed replaces stability, and solutions disappear faster than they can be created. Silver is unlike other assets. Stocks can be halted, trading can be paused, markets can be stabilized artificially. Silver can't. It has physical delivery obligations, and paper contracts are tied to limited metal. This triggers a feedback loop. Rising prices lead to margin calls. Margin calls trigger forced buying, and forced buying pushes prices even higher. Leverage amplifies this. Physical constraints intensify stress. $67 is the level where these forces collide. Short exposure, physical demand, and forced buying. Stability becomes fragile. Control disappears, and the market stops behaving like a normal supply-demand system. While most are staring at charts, smart money watches hidden signals. Margin requirement changes. Sudden jumps in these numbers indicate forced buying and stress. Clearinghouse notices, internal updates, not public news, reveal exposure pressures. Physical silver premiums rising show scarcity. Heavy borrowing from liquidity facilities signals tightening cash. Silence is the loudest warning. The calm on charts is misleading. True financial stress is quiet, precise, and extremely dangerous. Historically, the worst crises happen before the public sees any problem. Speed replaces judgment, and preparation becomes survival. $67 wasn't just a price. It was a warning, a signal that obligations are enforced, institutions are scrambling, and pressure is building. From that moment, trading became enforcement. Price discovery turned into obligation, and optimism shifted into risk containment. Most people will notice only when headlines explode. But by then, the real danger has already passed silently through clearinghouses and balance sheets. The key lesson is simple. The system fails quietly first. Loud panic comes later. $67 was the line where theory became reality and obligations became unavoidable. The question isn't whether silver moves further, it's how much stress the system can handle before something breaks. When that breaking point comes, speed replaces stability, confidence collapses, and exits close faster than you realize. To stay ahead, watch the hidden triggers, not the headlines. We'll examine what happens if silver opens above $67 on Monday.